Hello everyone, hope you are all fine. How hope each and everything is okay. As yesterday we were discussing, we talked a lot. We talked about the financial revolutions. We talked about how and where are we. Today I come to elaborate more about the digital financial revolution that started way back in in 2008, after the first and huge global economical crash that hit the world by 30% economically negatively. This is to say the world financial crash that happened in 2008. In 2019, early 2019, it gave to the birth of what we call the digital currencies. After what had happened and after some economists following what had happened, we got some individuals who came under an umbrella of a name known as Satoshi Nakamoto. They came to liberate the world from what we call inflation, with an inflation-proof policy that is called the digital currencies. What are cryptocurrencies? Cryptocurrencies, this is the next form of currency. As you hear the word currency, when we talk about currency, we always say that this is the money or this is the assets that are used in exchange, or the current valuation of money that is being used in exchange for other values. So the digital and the encrypted currencies, these are currencies that work on a ledger so much commonly known as the blockchain. When we come to the blockchain has been living with us, and it has been in various operations, such as the telecommunication, the telecommunication. The first use case of the blockchain was seen in the around 1942, when they started encrypting the communication scandals, so that the message in between two people communicating, it wouldn't go to the enemy part, or it wouldn't go to the enemy encounter part, as long that communication was blocked. In the blockchain, there is a transaction, or there is a policy that a transaction between 2 or 3 people is never known. A transaction or a communication between 2 computers is never known until you are given access to it. We have what we shall talk about mostly. It is called distributed ledgers. The distributed ledgers, this is when a transaction or when a ledger is distributed among very many individuals, that if you want to edit a transaction done between me and you need to collect various various devices for you to edit those ledgers. In a ledger is an accounting word, or for those who study financial accounting, you know the word ledger. A ledger comes in and say that this is a record of any transaction. So in blockchain, our transactions are publicly recorded. That once I make a transaction once a transaction is made between person A to person B, it will be known on the global ledger. That is what we call transparency in the blockchain system. And we don't need a middleman. A middleman is the system that is there. This makes transactions very low costly. That if you are sending money, for example, from Africa to Europe, you will find yourself spending the same money as the one is spending, the person transacting from Uganda, from Kampala to Masaka, you find yourself that the time taken between that distributed ledger transaction is very minimal. If a transaction from a person from Kampala to Masaka takes 1 minute, even the transaction from Kampala to America, or from Africa to North America, South America, Europe, Asia, it also takes 1 minute. So I call upon you, fellow citizens, sit down, understand how cryptocurrency can be helpful to you. There are various ways how you can come to be part of the cryptocurrency world. First of all, you can come as an investor. When I talk about the investor, I mean this person who comes in, inputs his money, and he or she waits for a particular period of time. You come, you have your money, you find a viable asset, you buy it, you say that I'm holding this viable asset for at least a period of 6 months, for at least a period of 3 months, for at least a period of 2 years. There you are an investor. You can also become into the cryptocurrency world, or you can learn about the cryptocurrency world through what we call high frequency trading, or trading of the currencies. Online trading of currencies is simply as when you have cash, you go buy dollars from a forex bureau. Maybe you come somewhere, you buy them, they are 10 cents lower. Then you go somewhere where they are 10 cents higher, you sell them. You sell, you come back, you buy, you go the other side, you sell. You are frequently buying and selling of the foreign currencies. You buy where they are less by cents, then you sell them where they are more by cents. You buy low and sell high. This is another way to join the cryptocurrency and earn from it. When I talk about trading or high frequency trading, there are some principles we look at when we are trading. Before you buy an asset, you have to do what we call analysis. Even this applies for investors. Let me come later on that. When you go after trading, there are various companies that have a product, or that have products equating themselves or calling themselves they are part of cryptocurrency. They come to the community, show you the product, and they need your assistance to help them sell those particular assets around your communities. Thus, you come in the cryptocurrency world, you participate as a networker. You sell products, you help them and become aware in your communities as they pay you. As we talk right now, there are various companies, there are various organizations that have brought a lot of affiliation systems that call you upon, come and sell our product as we give you a commission. These companies come in various assets or in various presences. Some will come with tokens. They will tell you that, come, sell our token, it will go until this value. The more you sell their token, the higher value that comes. And as you are selling these tokens, then you'll be rewarded in terms of commission. Once you are rewarded in terms of commission, or they may either award you, dependingly, they award you in return commissions based on those tokens you are selling or you are talking about in public, or you are given tokens or you are given a hierarchy that once you sell a token, they give you a percentage of money invested depending, or they give you a percentage of money invested depending on who has invested and how much he or she has invested. That is also another philosophy of earning. I will later elaborate more about that affiliation system or the marketing system on how to earn. Those are the major three ways to earn in the cryptocurrency world. First of all, actually there is one I've left, developing of a particular crypto assets. A person, if you are a developer down there, you can come, or you can go learn what we call the blockchain development. Once you learn the blockchain development, you decide to develop an exchange platform where people will come in, exchange their digital currency, which is online, and your platform is online, so it also becomes a source of income to you. Or you sit down, look at the measures around the community, evaluate them, value them, then later on you come and develop your particular cryptocurrency depending on the need of the community. That being a developer, it also rewards in various ways. That is to say, you can also earn through developing your particular token or cryptocurrency, although it has a lot of credentials to follow when you are developing a token, even developing an exchange. And another part of in development, you can also come and develop what we call a pathway. When I say a pathway, I'll bring, for example, a pathway of fiat currencies, which was usually used earlier on. That is Western Union, MoneyGram, and so many as you know them. Those are pathways. They don't hold tokens, they don't hold exchanges. Somebody needs to send money to a particular point, he creates that pathway where you come, send that money through that, it reaches the other person where you want the money to go. That is called a pathway. You can develop a pathway. Going back a little bit back onto the marketing department, we say that there are some people who come with the tokens. There are some people who come with developed softwares, commonly which is trending right now, the AI trading robots. It is also another source of earning. These people develop, or developers come down, sit down and develop what we call algorithmic systematic trading. A system that runs on an algorithm of trading, or a mathematical arrangement of characters that helps you execute, buy and sell assets. There are so many there. I'm not here to talk about those right now. I'll talk about them maybe tomorrow or another day. But there are so many trading softwares, i.e. what they call robots. These are good and they are worthy. But remember, this is a third party. But it will lead you to double costing. Because when you go to an exchanger, a renowned exchanger like Binance, it will, at each and every cost, each and every trade, buy or sell, there is a certain percentage that is deducted from you. And these softwares, they also deduct a particular percentage from you, thus forcing you to do double costs. And when you look at the percentages which the in charge of those software checks are set for you to earn on each and every complete trade. When I say a complete trade, I mean you take, you make and also take, or you take and also make. You buy and sell. After buying and selling, you have made a complete trade. You'll find out that if you make a complete trade and you make a cost of around $2, that goes between the exchange costs and the robot costs. This will be broken down in more of our videos to come. Personally, I don't recommend third-party exchanges or third-party robots because this is a double cost. I rather recommend you go and use the exchange software, trading softwares. This help you because it is inbuilt between the exchange. You will not do double cost because as a trade it takes itself, it only takes one cost at a time, thus saving you a lot of costs incurred in a particular trade. With that, allow me go back to what we told about trading of financial assets. Financial assets or trading of financial assets started way back when there was an exchange of rice and cowrie shells. Later on, it came developing depending on what we call the technological development. Each and every series, it came developing. Where rice was used against cowrie shells, then later on it came being used against minerals, then later on it came being used against what we call the coins and the papers, then later on it came into finance, what we call the Bretton Woods finance. As it developed, it reached an era where we had to say that this is an industrial era. During an industrial era, there was rapid development and downfall of various companies. This forced economists around the world to seek places and places to find a solution. And at this solution was found in a manner that each and every trade, each and every company needed what we call public funds. And thus, these companies wouldn't just go into communities to fish up the funds from the communities, thus calling for what we call the introduction of Wall Streets. Any genuine company that was in, or any genuine developing industry that was in for the community, it would go to a particular committee, and a particular committee would have allocated a particular street. It registers, it fulfills all the requirement, that company registers with the committee, then that company is given a stall on the street where it will display its prediction, its happening, and its history. So, renowned economists or traders, financial traders, around a particular jurisdiction or around a particular area, they knew about those streets. They would wake up, go on the streets, read on each and every stall, find out that if this company is worth this, if I put in money today, will it have grown by evening? After making that analytical part of it, they had to do what we call financial investments. After doing the financial investments, some would invest in the morning and sell in the evening. After selling in the evening, they would have made a profit, thus bringing the financial assets into the markets of trading. Some would come, buy the stocks of the company or buy the equities or the propositions of the company, aiming to sell after months. Those are called investors. And we had some people who were aimed to sell after few hours or within a day or within a week, aiming for a 5% within an hour or within a day or within a week. These are called traders. In trading and investing, we have various things we have to look at. And the major issue in trading and investing is what we call asset analysis. When I talk about asset analysis, I mean the examination of what is happening around this particular asset, onto that particular asset, on or before, and you make a future prediction of what will happen in the market. Financial analysis depends on human actions, which is commonly known as greedy. When an asset is making money for you, you always think, let me make more money. That is what we call greedy. Unsatisfactory of a particular human being. After making a particular money on a particular asset, these people will force or will tend to lack or to yearn for more money in that particular asset, thus causing what we call the greedy in the asset area. This brings a lot of uncertainty in the market positions or in the price actions. We have another human action, which is hope. Wherever a person is hoping that the asset will rise or the asset will fall, you are having high future hope of a particular asset. This causes you not only to have bright future, but it causes some indiscipline, the price action. The price may misbehave because of hope and what we call fear. Once the market is going against you, you'll find that 90% of the community who are engaging in the market, they will tend to run away and say, oh, the market is going to take my money. They will tend to remove all the money from the asset, thus causing fear, and it will lead the market price to go back down. So these are the three human factors that drive the market: hope, fear, and greed. And when we are making analysis, these are the major factors that we base on: human actions that we base on to predict the next happening or the next price action in the market. Analysis is done in two ways, majorly into two ways. We have what we call fundamental analysis. Fundamental analysis, this is the sitting down, analyzing and seeing the markets move, how they are moving, and how they are willing to move. In fundamental analysis, we look at the news events in a particular economy. We look at the political events in a particular economy. We look at the what we call the employment status in a particular economy. We look at the consumer consumption of goods and services in a particular economy. We also look at what we call the consumer price index of a particular economy. These are some of the few things we look in as we are looking at the fundamental analysis of a particular asset. You look at what is happening, what it is its prediction, what has it been happening. What has been happening in a particular asset, it is always analyzed in the technical analysis. This forces us to look into various surroundings in the market. Most of the technical or most of the investors base on fundamental analysis because investors are long-term viewers in the market. They are long-term, they focus on long-term. They don't focus on short-term as traders. Most investors, 70% of investors look, when you are investing, you should always look at the fundamental analysis more than technical analysis. This gives you the pace, or this gives you peace when you are investing in particular assets, and it gives you an overall or a forecast of a particular asset when you are investing in it. Secondly, we have what we call technical analysis. When I talk about technical analysis, this is the looking at the graphical representation of the market. This is the looking at the historical graphical representation of the market happenings. Such and such has been happening in the market. It is usually represented in what we call the graphs. After representing in what we call the graphs, we look at those graphs, analyze them, know what is happening, know what is to happen. Depending on the human action, fear, greed, and hope, you can look at the graphs and analyze. There are various graphs that we look in, but most commonly we have what we call the candlestick graphs, we have what we call the line graphs, and we have what we call the bar graphs. These are the most common graphs that are seen on the market. During technical analysis, only graphs, they are not enough for you to understand the movement of the tokens coming next. We add what we call other factors of confluences. In these other factors of confluences, we have what we call the support and resistances formed. Support and resistances formed, these are formed with the turning points that happen in the market. We have what we call market indicators. We have what we call market indicators and others. Let me call others as market indicators. These indicators include the Fibonacci retracement, they include the McDonald's retracement, or the McDonald's indicator, they include the moving average indicator, they include the what we call the RSI, and so many to mention, as we shall be seeing in our next videos. So, in looking at these charts, you only don't need to see the charts. Usually, the charts, they have their own language, of which we study through what we call the chartology analysis. We break to you the language used in the charts. When you see this chart formed followed by this, what should you understand? When you see this graph formed followed by the next graph, what do you understand? In the chartology analysis, we shall look at these things. We shall look at the anatomy. Anatomy, when I say the anatomy, this is the formation of a particular event. The formation of a particular event is called the anatomy of a particular asset. Then we shall look at what we call the patterning. As you are always in the alphabetic formation, we have what we call the patterning of these assets. You need one or two assets to make a sound from those charts. You don't need that this chart is like this and this chart is like this. No. We add them to, we can have 1, 2, 3 or 4 charts that come together to show you the meaning. And you need to bring those charts together depending on how we are going to allocate them to see that, you know, here I'm expecting this. Not forgetting that after bringing them together, you don't forget what we call the factors of confluences and the indicators in most cases. With that, allow me to stop there for today, having introduced to you what we call the trading. The trading is this is the continuous buying and selling of what? Financial assets in order to gain a particular value or a particular profit, which is a little bit of simple percentage needed occasionally. Occasionally it may be needed within 4 hours. Every 4 hours you have a particular percentage you need in the market. Every daily you have a particular percentage you need in the market. Every weekly you have a particular percentage you need in the market. We also have what we call the investment or the investor. An investor, this is a person who needs a particular percentage in the market on a fixed occasion. For example, you need your percentage on 6 months period, 3 months period, a year, 5 years, 10 years. With that, stay blessed. Let us meet in our episode that will come tomorrow.